Brad Williams, Frugal Finance, a short hedge example. This will be shortened to the point. Interest rate futures can be used to hedge a variety of risks posed by fluctuating interest rates. For example, hedges constructed with interest rate futures are useful for banks facing an interest sensitivity mismatch between their assets and liabilities. Suppose that in March, a bank customer demands $1 million fixed rate loan for 9 months. The problem the bank faces is determining the cost of funds over the term of the loan. If the bank could issue a 9-month, $1 million fixed rate certificate of deposit, it would have a precise match between the interest sensitivity of its asset, the loan, and the interest sensitivity of its liabilities, the CD. However, suppose that the bank can only lock in its funding for 6 months at 3%. To fund the loan for the entire 9 months, the bank will need to issue a $1 million 3-month CD quoted in March is 3.5%. The yield provides the bank with the market assessment of the 3-month CD rates. That will prevail in September. This assessment is helpful to the bank in determining an expected cost of funds over the life of the loan, but still leaves the bank vulnerable to rates rising above the expected rate. Here, you are investing in the instrument. Going short means going short on price. So if the instrument price moves lower, interest rates move higher. The bank can hedge this risk by placing a short position in March-September Eurodollar futures. In constructing the hedge, the bank will use a single futures contract. If rates rise unexpectedly, the Eurodollar future price will fall and the bank's short position will become more valuable. Suppose, in fact, that the 3-month rate rises to 4.5% in September. We know that the Eurodollar futures price yield must converge to the prevailing 3-month rate at contract expiration. What this means is that the bank's Eurodollar future position gained $2,500. This amount precisely offsets the bank's increase in its cost of funds over and above the 3.5% rate it expected to prevail at the time the bank loan was priced and the hedge was constructed. Table 514 displays the cash flow associated with the construction of this hedge. Of course, by hedging, the bank has given up the opportunity to make extra money if its cost of funds had fallen unexpectedly. However, by hedging and locking in its cost of funds, the bank is able to price the 9-month fixed rate loan with certainty and lock in an acceptable profit. So here, you're investing in the instrument. Going short means going short on price. So if the instrument price moves lower, interest rates move higher. What did this manager do? The bank makes 9-month fixed rate loan financed by a 6-month CD at 3% and rolled over for 3 months at an expected rate of 3.5%. Establishes a short position in September, Eurodollar futures at 96.5, reflecting a 3.5% futures yield. In September, the 3-month SOFR rate is now at 4.5%. The bank's cost of funds of 3.5%, the additional cost equals $2,500, 90 divided by 360 times 0.01 times a million. Total additional cost of funds is $2,500. Offset one September Eurodollar futures contract at 95.5, reflecting a 4.5% futures yield. This produces a profit of $2,500. 100 basis points times 25 per basis point times one contract. Future profit $2,500, net interest expense after hedge 0. So this is just a perfect matchup. Realistic? No. But again, this is just training. What you need to do if you're in a banking situation, you may be running into this day in and day out. And maybe this is just a helpful tip on covering or hedging your positions. Brad Williams, Frugal Finance. Hope that helped.